Okay, so here's part two. I'm not sure what I'm going to name all this, but here, we're on part two of the conversation. Just follow along. I'm going to do my best to slow down and be clear as possible, as I possibly can. Okay. So, there are two different aspects to this strategy. Each aspect has its pros and cons. All right. I've made videos about this before, but I will briefly mention what those pros and cons are without being too long-winded and getting too much off the topic. All right. Even though it's all related. One of the pros is the percentage yield that you're going to get for current market movement. Now, the percentage yield for current market value is not that much, but it's still a pretty good percentage yield after 30 days of holding. Okay, after 30, 60, even 90 days, you won't get that much of a percentage yield. But here, there is something that you can actually do to kind of circumvent that or help your percentage yield. And this is what you gotta add money to your account. Okay, we call it the progressive growth approach. You have to progressively assist your brokerage account by just adding money. When you add money to your account, all you're doing is you're giving your margin level percentage a higher boost. So if you add money, let's say you're at 1,000 margin level percent and you're on current market value, which is our long-term holding strategy, then all of a sudden you want to make more because the percentage yield is not really going how much you would like to see. You add money to your account and then you can have more purchasing power. So you just basically add more, and over time it will reflect similar to what a current market movement strategy would reflect when it comes to percentage yield. Okay, you'll get a higher percentage yield by progressively adding more funds to your account, giving yourself more purchasing power, also allowing your margin level percentages to be in a safe area. Okay, so let's get back to the analogy that I started with on part one of this conversation. The storm is coming. You're in an airplane. You got all your gold bars, but then all of a sudden the storm comes. All right. And all of a sudden what starts to happen? It starts to stress out your airplane, your aircraft. And now guess what? Your aircraft is starting to go down a little closer to the ocean, to the sea. That's what's happening. All right. And you're trying to just avoid the lightning and all the other stuff. Make sure that you're going to make it out alive to your destination. Your destination represents your final end goal, which is the profit you're going to make. You're not trying to lose your cargo. But here's one of the most common mistakes that a lot of beginners do. I did that. We all did this at one point, and some people continue to still do it. And that's over purchasing. Okay, that goes back to the margin level percentage area. The higher up you are in the sky, you can look at that as your margin level percentage area is at 1,000%. If you're not sure what I'm talking about when I say margin level percentage area, there's a section in the here. This is what I'm talking about. Let me show you. All right. You see where it says margin level percent right here at the top, right underneath the bits. And by the way, this is bits. This is not US dollars. So this is not $42,000. This is all bits. This account is in bits. But here, margin level percentage area, and then it says 1,134. That's the margin level percentage area. So it's at 1,000 or above 1,000%. So you're safe. And guess what, guys? There's a storm happening. But if I looked at this account, I wouldn't think that, because this is current market value. But that's another conversation. So let me continue with the analogy. When that storm starts to go and take toll on your plane, on your account, you're going to start to notice your margin level percent can drop drastically. And here's the key factor. It depends on how much assets you're holding. Now, you could have overburden your aircraft with too many gold assets or too many whatever assets. You probably overpurchased. And that means that your margin level percent might be at 400. Now, when a storm comes, it can knock your margin level percent by at least 400%, guys, depending on the nature of the storm. And if you're already at 400 margin level percent and a big storm comes, well, guess what? You're going to be at zero. And that means your plane's going to crash into the ocean where all the sharks are. And that's the brokers, guys. Your brokers are not really that friendly when it comes to their interest. They have self-interest in themselves. They're making money off of your losses, really. Really what it boils down to. Similar to how the Vegas casinos work. If you allow them to operate that way, if you want to beat them, so to speak, and don't fall into the ocean and crash and get eaten by the sharks and lose everything, your whole investment in your account, blow your account, then follow that risk management rule that I'm talking about. Okay? So that's the analogy that I give. Now, let's get back to the storm now. Now, the storms are going to come, guys. I already said that. Now, let's go to actually, I already did that. I showed you guys the current market movement, where we're at. I noticed that there was a storm approaching. Now, that depends on you. Some of you guys, if you feel like you can go through the storm, fine. I'm talking about current market movement now. On Monday, if you join and you make your trade and you see a storm coming, we started seeing the storm started to manifest somewhere around Tuesday. Some strange little scenarios. Again, how do we know this? The stress indicators that I put on the daily financial market report. Started to see these indicators starting to come, and I'm talking to the members in our group, and I'm telling them, hey guys, this gold is acting funny, the dollar is acting funny, and all this stuff, and stressors are coming, and all of a sudden, and boom, then what happens on Wednesday? More stressors start to appear on the report. Stress, some extreme stress, other stress, more stress, another extreme stress, and then finally. So then Wednesday, I said, well, guys, I think we're going to just go ahead and collect. But you know what's interesting is this. On Monday, we placed a trade. Tuesday, and then here Wednesday comes. So technically 2 days, 2 complete full days, okay? On average, 3 days. Usually Wednesday, you don't find that big of a storm. But here, we collected on Wednesday, so Tuesday, Monday, Tuesday, Wednesday. So 2 to 3 days, depending on how you look at it. We got out of there. We bailed. Collected all I needed to collect. I told you guys I was going to do that anyways. Again, why? Extreme stress on the report. Stress here. Extreme stress there. Stress takeover. I'm just like, whoa. Here you go. Sure enough, what happened? Here we are today. November 19th, Thursday, the next day. And that's where I want to talk about. That's where I want to continue, and I'll continue on the next video. So guys, follow me. Meet me on part 3, you guys.